Find today's guest at jtfutures.net. Please welcome Justin Givler.
All righty, thank you, Dave. Hello, everybody. I want to thank you guys for taking some time out of your day to spend it with me today. What I want to do today is share with you how I scalp the Emini S&P futures. I did a presentation about a month ago, maybe 2-3 weeks ago, with NinjaTrader, where I laid out basically how my trading system works, and that included high time frame analysis. It included all the different nuts and bolts of what I use to trade the futures market. And today I want to just dive into the details and get into one specific part of the strategy, which is putting trades on in a scalp environment. So without further ado, let's just jump right in. I do want to give you your futures trading risk disclosure. I'm sure all of you are already aware of this stuff. Futures trading is risky. You could lose all or more of your initial capital. Everything I present today does not necessarily mean it's going to work going into the future. All that kind of stuff we have to lay out before we jump into this for legal reasons. So let's go right into it. If you want to, like I said, if you want to learn more about my entire trading system, more about who I am, all that kind of stuff, just go to my November 3rd futures trading NinjaTrader ecosystem webinar presentation. You can get it at my website, jtfutures.net. And once you go to that website, you just go to the events tab and you'll see right in there the information about that webinar and the link for it, or there is the YouTube link right there at the bottom of the screen. So let me just go through this really quickly. High time frame analysis is a huge part of my trading system overall. I'm using higher time frames and multiple time frames to find the strongest levels and to find the direction, the overall direction of the market. It helps me narrow down areas where I would then want to narrow down to my scalping strategy to look for trades, right? So what I'm doing is I'm mapping out all the areas in the market that make the most sense for there to be some type of support or resistance. And so I can basically sit back and wait for the market to get to these areas, and then I'm going to go ahead and initiate my scalping strategy. It's really not necessary to do this higher time frame analysis if you're a true, 2, 3, 4, 5 point scalper on the ES. In terms of points, this is very specific to the S&P, but if you're trading the NASDAQ, you're looking at probably about 4 times that, right? So just keep in mind, this is all going to be S&P focused. So you really don't need to work with higher time frames if you're just scalping for a few points, and you'll see why as we get into this presentation. So let's go ahead and jump right into it. So we're going to be focusing in on the 512 tick chart. I know there are a lot of people that say that these type of short time frame tick charts are horrible to work with. You should be ironing things out, moving up to at least a 1 or a 3 minute chart. But for me, what I found, and I've been watching this chart now for probably over 5 years, almost every single day, it's something that I have become accustomed to. So as a trader, you really have to find what works for you, right? And what I found was the 512 tick chart was just the perfect thing for my eyes, and I gravitated towards it, and from then, have been spending almost every day watching it. So on the 512 tick chart, what we want to be looking for is, like I mentioned just a few minutes ago, good levels to rely on, not necessarily determined from higher time frames, but good levels that we can rely on that typically hold for support and resistance. We want our divergence, which is going to be sort of our signal or our trigger to actually start the trade or actually put the trade on. And then the most important part of any type of trading system is risk management. So we'll get into how we're using the 512 tick chart and the various tools and levels to determine very low risk scalp trade setups. Okay, so first things first, divergence was probably maybe the third or fourth things I started looking for back years ago when I started getting into trading. I was looking at all different kind of indicators, but the one thing that stuck out, no matter what indicator I was looking at, or specifically oscillators, was I noticed those divergences showing up all over the place. This presentation is not going to be what is divergence and all those little things like that. So I'm not going to sit and define it and everything, but essentially my eyes gravitated to divergent setups. Every time I saw a divergence, it essentially was about when the market was about to make a turn, whether that was the turn on the 512, on the 3 minute, or the hourly chart. Okay, so you can use all different types of indicators. You can use intermarket analysis to look for divergence. There's all different ways of doing it. And for me, and you'll see as we get into this, I'm primarily looking at RVI, but I have recently started bringing up the fast stochastics, and then I have a proprietary sort of oscillator with some settings that I use that I've added on very, very recently. But primarily, divergences for me are on the RVI indicator. So comparing price with relative volatility index. So like I mentioned just a few seconds ago, we're using it to confirm the setup, confirm the level, and then once that signal is there, we're using it to trigger the trade. So there's this idea of fractals. And if you've spent a little bit of time with markets and with charting, I'm sure you've already noticed that you're going to see certain patterns on a daily chart, and you could zoom in all the way down to a 1 minute chart and see the same exact patterns. And that's what we mean by market fractals. They're price or divergence patterns that repeat on various scales. Okay, and we see these happening not only every few minutes on the shorter time frames, but every few hours, every few days as we move up in those time frames. So these are our trading setups, right? When these fractals print and we're at a good level in the market, that's it. All the criteria has been made. We are now taking the trade. Support and resistance in fibs. This is primarily the levels I'm looking at when I'm trying to narrow down those areas in the chart that make sense for support and resistance. So I'm looking at just basic support and resistance, right? So that could mean previous lows, previous highs, and we'll go on to the chart and I'll visually define it for you. I find a lot of things with trading, you read something, you see the words, you go, okay, kind of makes sense. When you get to the charts and you see how it looks visually, it all kind of clicks. So dynamic support and resistance, moving averages. I primarily rely on a short and a long moving average on my 512 tick chart and a VWAP. And we'll get into details on that. And then fib retracements, or Fibonacci, or other known as retracements, the 38.2, the 50, and the 61.8. We see those levels hold over and over again. So I find those to be important to be aware of when I'm mapping everything out on the market. And then finally, we have the previous day open, high, low, and close. I don't use the open. I probably should update that. I really am only looking at the high of the day before, the low of the day before, and where the market closed at the end of the day from the day before. Because a lot of times we see the market go right back to where it closed the day before and rotate, reverse right off of it. And it just comes with time of watching the market day in, day out, seeing what's going on. And sometimes maybe it doesn't necessarily hold that level, but that level becomes a very relevant support and resistance level throughout the day. And finally, we've got the Hopal, which is my holy orange power level. It's one of the two things that are essentially proprietary with me that I don't really give the secret. It's a level that is populated on the chart at 6 a.m. Eastern, and it's calculated based off of overnight price action. And this is a level that I just kind of I stumbled upon it just with all the different things I've been doing on the market. I was watching this one level, again, calculated off of some things that I saw in the overnight session. And almost every day, the market would come to this level and reverse, kind of like the close of the day before. Does it happen every day? No. Does it happen all day long? No. But there are some incredible setups off this level. And when you can kind of refine the trades you want to take using things like divergence, you can then, you know, have a little bit more confirmation that maybe that level will hold when we do come into it and test it. So those are the kind of levels that I'm relying on. And then finally, I just want to talk about risk management. And what most of the presentation is going to be spent on the charts. I want to get into the actual live charts and start looking at the setups, looking at how I determine what fib leg I want to use or what support and resistance level I want to use. So we're going to finish out kind of the theoretical side of things here, and then we'll get to the charts. So as I mentioned at the beginning, risk management is probably the most important thing for a successful trading system. I've said this before, and I think a lot of other people have also said, you could have a crappy trading system, but if you have good risk management, you could actually make money. In fact, there are so many different ways and so many different strategies for trading the markets, and the reason why they work is because you're using proper risk management, right? So we want to find levels that when they hold, typically hold with minimal risk, right? So if I know a level holds, say 60, maybe 55% of the time, then I know that that's probably a level that when it comes down and into it is a potential hold from that level. And we'll get into the charts so you guys can actually see what I'm talking about. And you only want to enter trades that rely on the actual levels we just talked about, that check all the criteria for your trade setup, and that do not take on more than your predefined risk. And that's something you're going to have to determine yourself, right? I can tell you that my risk on most trades is 2 points. Some of you will say I'm crazy. Some of you might say I only keep a 1 point stop, right? That's going to come down to a number of factors, but most importantly, your statistics. So if you're taking notes for all of your trades, you should notice a pattern, right? And you should notice that certain trades typically hold within a certain amount of points. And over time, I don't have the time today to get into all that kind of stuff, but using statistics, you should be able to determine what makes sense for the tightest stop you can possibly use. So in that case, let's just say it is a 2 point stop, right? Like what I use. This means that if you have a trade opportunity off of a level and the market pushes into the level, it turns, starts going in the direction you would have expected it to go, and you don't put the trade on, well, now you're accepting more risk on that setup. And so that's why I'm saying, from a perspective of keeping your money, you want to just forget about those type of trades. So let's say you have a trade set up, you missed it. You're now, if you get in late, you're now putting on 2 times the amount of risk. It's probably better to just forget about it, move on to the next trade, which for me was one of the major hurdles in trading, was trying to get over the fact that I missed out on setups. I would actually have like some tension psychologically that I just missed a trade, and man, I could have made all this money on that trade and all that kind of stuff. That kind of stuff can really start messing with you. So let's go ahead and let me talk about this, and then we're going to get into the actual charts and look at how all this stuff is working. We're looking for, like I said, low risk scalp opportunities, and we're looking for confluence. So when there's 2 or more independently derived levels and a divergent signal lining up at that level or area in the chart, that's what we're talking about. So let's say we have a 61.8 fib retracement level lining up with one of our support and resistance levels that we drew on the chart, and then a divergence prints as the market is testing that level. That would be your confluence. and be your trigger to take the trade. So here's just a quick example of divergence fractals. And again, these are just patterns that repeat on multiple scales, okay? Don't worry too much about names. There's people that are like, oh, was that a classic divergence? Was it hidden? Let me tell you something. I've been watching these divergences for years. It doesn't matter. It really doesn't. If there's a classic divergence, if it's going to hold, it's going to hold for your setup. If it's hidden, it's going to hold for your setup. The most important thing is we're using these divergent setups to define our risk, to know where the turn is in the market and know where we're right and where we're wrong on that trade setup. And we'll get into that on the chart. So looking down below us here, you can see these are some examples of divergence fractals or divergence patterns that we want to use for our trade setup. So on the left, number 1 there, I don't know if you can actually see my cursor, but on the left here, we have the first example. You can see at the top in blue, that would be kind of your theoretical price action. And down below, there's your theoretical indicator action, or maybe in your case, it's a separate market or something like that, a correlated market that when it starts to do something opposite of what your market is doing, that would be your setup, right? So in this case, price came up to a high, it pulled back and then pushed to a higher high and then started to sell off from there. The indicator in this instance would do the exact opposite, and that would be the pattern that would clue us in to a potential divergence setup. I'm not going to go through the other 3. These are just common patterns that I see. Some of them I'm a really big fan of, like the setups when we come down, we bounce just in front of a level, and then the market comes down and actually comes right into the level, and we get divergence. That's a favorite of mine. And then these double bottoms, or vice versa, double tops, when we have the market test a level, get some type of impulsive move out, and then it fails and comes right back and bounces right there, right to the tick or within a tick or two, but our indicator is drastically different. That's usually a sign that that thing is going to turn for an attempt of a larger push, right? So with all that stuff out there, what I want to do is actually go to the charts and just start showing you how this all works. So I'm going to pull up my 512 chart here, and we'll go back, and I'm just going to start from November 18th here, just because I went back a couple days and found some really good examples here. So let's look at this. Hopefully everybody can see this clearly. Just checking the chart here in the chat. I don't see anyone saying anything, but hopefully the chart is coming through nice and clear. So remember I talked about fibs as being one of the important strong support and resistance kind of tools that I use. Here's a great example of going into the overnight session on November 18th, or at least going into the overnight session. We had a nice move here going in, well, this must have been the 17th, right? So we had this nice push from down here all the way up, and then in the going right into the beginning of Globex, there was a pop right up to there. And we had a nice leg up from the afternoon low from the day before all the way up to the high at the beginning of Globex. This is, I'm defining this as a Fibonacci leg that I would then want to look at retracement levels for as the market, or if the market was to begin pulling back, for me to find entries. So I've got a leg here. So let's go ahead and draw a fib across. Okay, and now you can see that going into Globex session here, it did pop right at the open of Globex, and it started pulling back, but we already had predefined here an area around 38.2, an area around 50, and an area around the 61.8. These are 3 general areas that we typically see hold more often than not. However, there are days where we're just chopping back and forth. very rangy. Sometimes fibs don't work at all. And I think this is a good opportunity for me to mention that it doesn't really matter what you're using for trading tools. You could be trading Fibonacci's, you could be trading my support and resistance, you could be trading order flow, whatever it is, it's not going to work every time, right? In fact, you might have an entire week where things just aren't working out. There are definitely certain days that I've noticed where you might have a day where things are working incredibly, like magic. Everything's working perfectly. The next day, everything has been like tossed out and nothing is working the way it did the day before. So you have to remember that whatever it is you're using to trade, it's not always going to work, right? These levels, it's not like the market's going to come to the 38, the 50, and the 61 and bounce 100% of the time. Although I will tell you, if you start watching fibs, you're going to be pretty blown away at how often they do react at those areas. What I'm going to do is bring this out, maybe let's bring it out to the 18th so we can at least see it extend out. And so now as we're pulling back, we've got our fib retracement of the previous leg, okay? We've got the 3 fib levels, and now we're looking to see as we come into these areas, are we finding some type of divergence? And in this case, what happened was we came 1 tick from the 38 here. And in fact, we were finding a lot of support there just before the push at the end of the day from the day before. But 1 tick in front of it, we got our divergence set up. If you look down here, I'll go ahead and bring this down. This is my RVI down here. So if you're wondering how I'm getting my divergences, I'm looking down at RVI at the bottom of the screen, and then I'm comparing it with the price. So here you can see we've got a double bottom, right? Price came down, bounced out, came back and bounced to the tick or within a tick or two of that level. However, here's that fractal I told you about. The indicator made a much more significant low, much higher low than what happened here in price. So that was essentially a decent trade setup right there to take it long right off of the 38 with a nice divergent signal. And that's a scalp setup about 2 hours into the Globex session on November 18th there. Now, remember I said that just because you have 3 good Fibonacci retracement levels doesn't mean they're all going to hold every single time. And in this case, what happened was they did hold the 38. They got an attempt to break out. However, there wasn't enough bullish cooperation and the sellers regained control and continued to pull back, right? Ran out of buyers here, started pulling back. The 50 in this instance did not work out, right? However, if you look, as price was pulling back down into the 50 here, we were making lower lows compared to that previous swing, right? And the indicator was also making lower lows. So there wasn't a divergence there. So even if we were pulling back to that level and we were in real time there, we would have seen we were still pushing to lower lows and we were getting lower lows on the divergence. So there really was no divergence there. So it does end up bouncing. Interestingly enough, it reacts right off of VWAP, which is one of our moving averages, which is something I haven't spent enough time showing you here just yet, but came right into it, pulled back, and then we bounced 1 tick in front of the 61.8. And in this instance, look at the divergence that we got here. Significantly higher low on the RVI indicator, significantly lower low on price. And we were right at that beautiful little area that would make sense to hold. And sure enough, got a beautiful push throughout the overnight session, okay? So that's just one example using Fibonacci. What I want to define now is looking at these moving averages that you see on the screen. So remember, Fibonacci is just one way to narrow down levels. Another way that I narrow down levels when I'm looking for a scalp setup is using a fast moving average to basically track these little micro pullbacks when we're in a strong impulsive move higher. You're going to see this happen whenever there's a strong move. You're going to see these shallow pullbacks, and if you find the right fast moving average, that's going to be key for finding those entries if you're trying to jump on board with one of the bigger moves. The other one is our slower moving average here, and this is for bigger pullbacks. And I don't know if there's a perfect example here. Well, here's an okay one where in the overnight session, again, we're still November 18th here, we got this nice move up, and then there's a slight correction, kind of like almost a reversion to the mean, if you will, and then comes right back to the slower moving average and gets support for the bounce. In this case, not enough buyers were willing to pull this thing higher, right? So it failed, interestingly enough, right off that red line there, which was the high of the day before, previous daily high, okay? So the slow moving average is typically going to be a really good trade. And let's see if we get an example here. Beautiful. We're in a nice move, right? Again, shallow pullbacks, but it continues going in that direction to the downside. And then we get a larger correction that comes right into the slow moving average and then continues to fail. If you've spent a few years in trading, this should all be pretty straightforward stuff. You should already be aware of these pullbacks to these moving averages and reversion to the mean trades. And then finally, you see there are 3 of these, what I call dynamic support and resistance lines. The third one is an even longer moving average, and that is the VWAP, volume weighted average price. Again, I'm not going to go into defining it and all that, but basically what I do is I just anchor my VWAP to the Globex Open, and I've done that for a long time now, and it's been a very, very reliable level for me. So we've got 3 moving averages. I guess you could say 2, and then you have the volume weighted average price, which is essentially a moving average. And then we've talked about fibs, and we showed a great example of how we can use fibs to define strong levels in the market. So here's a great example. As the market broke out and we got a strong impulsive move, in this instance to the upside, notice where the market is pulling back to and basically holding right off the fast moving average, right? And then once it fails and starts moving the opposite direction, you then start finding that the market has trouble getting through. In fact, maybe what I should do is do that, right? So you see that when the market starts getting a good move in one direction, it will typically come up and hold the general area of the moving average. In many cases, comes right to the tick. This actually was 1 tick above, I believe, but a lot of times you'll even see you right to the tick. We come up and fail, right? So we see it on the fast moves. We see beautiful examples when it breaks out and then pulls back into the slower moving average, like there, or like right over here, where we corrected right back up, and yeah, we peaked through it, but essentially held that slower moving average and then continued to move on the merry way, again holding that fast moving average as it continued moving. Okay, like I said, it doesn't work every time. You're going to have stuff like this where it just kind of chops up and down through it, and then every once in a while you get a little hold, and that's just the nature of how the market works. Nothing is going to work every time. If that was the case, we just have everybody sitting at home taking that trade that works 100% of the time. No one would work, right? So I think we've established that fibs, and I'm going to show you some beautiful examples where they all start to come together, where we see fibs, we see these dynamic support and resistances, and we see our divergences all lining up in the same place. So I think I sent some stuff up here. So here's a really, really beautiful kind of textbook trade setup. Remember, I talked about having that ideal trade setup. Here's a great example of that. It's going to incorporate fibs, dynamic support and resistance, and divergence. So let's look here. The market came up. I think everyone can agree that at least within this local time frame here, the market came up to this area, made a high, and started to pull back. right? Well, as the market pulled back, we did have a number of different fib legs, and I don't have necessarily enough time here to really teach you how I draw every single fib leg and which ones I like, which ones I don't. But essentially, as the market starts to sell off from a high, that's when you have to start drawing your fibs, right? And as it makes lower lows, we then have to continue to draw new fib legs until we end up getting to an area where it finds major support, or at least a minor support, and starts to come back up higher to test into the retracement levels, right? So here we've got a high in the overnight session, or the pre-market session there, just before the market opened. Market opened and started selling off. And so what I'm trying to define here is, what leg am I looking at? Where did I get this 38% retracement from, right? It wasn't from this little leg here, or it wasn't from, just this high down to this high. It was from the high of the overnight session right here all the way down, and then I had to keep drawing it as we kept making lower lows, and essentially we came all the way down to this low right here, and we got this bounce. And I don't know why this is slightly off here. It might be because I did the actual session. Oh, that's why it's not all the way up to the top. So give me a second here, I had that in wrong. So the fib leg is actually just 2 ticks in front of the level, but it still works. So we've got a fib leg down from the high of the overnight session all the way down to the low around 20 minutes after the open here. And so as the market started progressing back higher, we noticed that we had a 30% retracement level right around 77, 75 there, take a few ticks. I think you would also agree this is now bringing in support and resistance. I think you would probably also agree that we had some pretty good support over in this area of the chart coming all the way through this area, right? Market came down, held on 3 tests, and then even though it did advance up about 20 points in the overnight session, when it did come back down, found support right off that level for 1, 2, 3 tests and bounced back up again. So we've got a level that makes sense from a support perspective. And as you should know, with support and resistance, what is one support can then become resistance, right? So we have a support and resistance level coming across here. We've got the 38% fib leg, and this is why I was looking at the wrong high down over here, right? So we have the fib leg down. We've got a support and resistance level coming across from that area in the chart. Just looking at our short time frames, we've got the 200 moving average sitting right here, okay? And we have divergence. So if you look back to the last major swing high and you compare it with the swing high here, we've got that double top. Remember that pattern I talked about, having the high pullback, same high? Well, look what happened here. Extremely higher high on our indicator, but a double top on price. So let me ask you, if you were pushing up into the 200 moving average here, that's my EMA, my slow moving average, you notice that it was also just about a few ticks away from the 38% retracement level, which is this little dotted line coming across right here. And you notice that your indicator was drastically higher than where price was in relation. Would that be a trade that you would want to take? For me, that checks all the marks. I've got the major retracement level. I've got my 200 moving average. I've got a very glaring divergence. That would be a trade I'd love to take. And from there, look at that. We've got, this is ES again. Remember, ES, about a, 15 point, 20 point pullback. Okay, from a trade where we had a little pocket between the 200 and the 38 there, and look what happened, came right into it and pulled back, okay? Let's look at some other quick examples, and then I want to talk about risk management. And let me see if I can get back to some of the setups that I was looking at earlier. And let's see here. Beautiful. This is exactly what I want to look for. First of all, before we get into some of these things over here on the right, do want to also just point out again, this leg down back over here, back from where I had a beautiful short setup. We had a new leg down, right? Came down to this low, bounced up, and look at where the market found major resistance, the 61.8, and again broke it by less than a point, broke it by 3 ticks there, and then continued to sell off from there. So just kind of something interesting to note. Get rid of that. And then once the market held that 61, came down and made the new daily low over here, notice that when the bulls regained power, brought the market higher, should say ran out of sellers, we came right into VWAP. And notice what happened here. Some failures right in front of it, some little peaks through and fail, and then one final. And this is usually the case with trade setups, is you get a beautiful setup, it holds, and then they come right up, maybe take some of those stops out, and then take the market exactly where everyone was expecting it to go. When it did that, what happened here? We came down, had a new fib leg down, and bounced right off the 50% retracement, 2 ticks through it, through the 50% retracement there. You can also notice here that we do have some pretty major divergence going on with our indicator and with price, right? So we've got a 50% retracement on this little minor pullback. We've got a very glaring divergence off those highs as we test into the 50% retrace. And then if I could clean this up, let's see if I can get rid of some of these lines. Maybe I'll get rid of that. And bear with me here. I don't think I'm going to be able to, is that it? Okay, there we go. Notice that where the 50% retracement was, where I just deleted that line, we also had a pretty significant little area of support here just maybe a half hour before, right? So we have a really nice ledge that ended up becoming a resistance one time before that. So from a support and resistance perspective, somewhat of an argument there from a support and resistance. And again, fib and plus the divergence. So hopefully this is making some sense. I haven't looked to see if there are any questions just yet, but hopefully this is kind of making sense that as the market is developing, we're drawing fibs over the legs. We're seeing where those fib levels are and seeing if they line up with other things in the chart, whether it's a dynamic support and resistance level, whether it's a strong support and resistance level. These are some levels I already had on my chart based off of higher time frame analysis. And notice where the market turned, right in between those two, that tight little pocket there. And then the divergences, right? So let's move forward here and just show you again, holding the fast moving averages as we get into an impulsive move. And then this right here I have circled. Whoop. This is another beautiful Confluence setup where we came up into the retracement level. So this whole sell-off from the high around 830 here all the way down, we had a new set of fib legs for this whole push. We had the 38, the 50, and the 61. Well, it turns out that the 38% retracement was also sitting at our slow moving average. Okay, not only that, if you go back and you see pretty significant area of support in the market right here, right? Within this little 1 or 2 point range, we had a significant swing in the market from that area. So, and notice also that the market broke through that level and, broke through that level and never really came back up to test it. That's another concept that I don't have time to get into today, but I guess there it is right there. A lot of times when you have a strong support, you see the market rip through it. When it comes back up to that level, more often than not, you do see a nice reaction there. So we have support and resistance from that level. We have the 200 moving average, and we have the 38% retracement of what I would say, excuse me, is a pretty significant move in the market here going into the lunch hour. Okay, so let's just pretend like we couldn't see what actually was going to happen next, and all we could see was this. We saw we had a 38% retracement right here. We saw the 200 was starting to come down into the 38% retracement. We zoom back and we look at the most significant support and resistance level. It's sitting right there. And we're looking at price right now, and it's slowly advancing bar by bar right into the shaded region, the fib level, and the 200 moving average. Well, I'd say the stars are aligning in that area or that level of the chart that makes sense for there to be a rotation there. And then what is the icing on the cake? We get ourselves a nice, beautiful divergence right off the level. Okay, it's kind of like a double divergence. You get the divergence just before, and then it kicks up, and there's that fractal pattern. We essentially get a double top on RVI, but a much more significant high on price. And there you go, there's your trade setup. And from there, we do get a pullback. Now, sometimes they don't work. Sometimes you get like a 2-point pullback, like right there, from 54 to 52. Next thing you know, it's bouncing and continuing to move higher. And that's where risk management comes in. Sometimes it's not going to work at all. Sometimes it's going to get a nice little shallow pullback, but not quite hit your target, and then rotate and continue going against your position. And that's why you need to have some type of set, defined risk for your trade setups. And it just so happens that we have the tools for it. Because why? Well, because we know our fib retracement levels typically hold within a point or two when they do hold. We know that our fast moving average, and I think I just moved that fib, I'll just get rid of it. We know that the fast moving average typically holds within a few ticks when it's going to hold and move. And why do I say that? Because when it does, it does. You see these holds to the tick off these levels, or if not, it's within a few ticks, right? When it's an ideal trade setup, okay? Look at how many times to the tick or within one tick we come into the fast moving average, right? So what is that telling me? That's telling me that if I want to take a trade off this level, it better work within 1 or 2 points, or else I don't want to be in the trade. There are instances where we get a deep peak through the level, it goes more than 2 or 3 points, and then comes back. And if you were holding on with all that risk, you might have actually been a profit and got your profit, I guess you could say. But for me, it makes more sense to just close my losses quick, because there's always going to be another trade setup. Like I said earlier, if we come up into a level, we get a double top. In this case, here's a beautiful example of a double top off the close of the day before. That little white dotted line is the close of the day before. Interestingly enough, see if I can zoom back out. We bounced from the low of the day, came all the way up, and then interestingly got a double top off the close of the day before and fell. Right? So there's just another example of one of those levels working to the tick. So let me just stop here and just make sure there aren't any questions related to this stuff. And I don't see any questions, so I guess I'll just keep on going. So we need to have some type of defined risk. All right, and the only way you can really do that is through screen time and statistics, right? So you're just gonna have to, whatever it is you're using, whether it's VWAP or some type of whatever, with something I don't follow, you gotta sit there and spend the time and just watch it for day in, day out, and keep those stats so that you can build up a somewhat objective number, right? Remember, the market is always changing, and that's what makes it even more difficult, is that when you have a nice set defined risk, the market could change and widen that by 2 or 3 points, right? But essentially over time, what I've found is 2 points is the magic number off of VWAP, off this slow moving average, off the fast moving average, and off of the relevant levels I mentioned, bigger support and resistance levels, previous daily high, previous daily low, things like that. For me, 2.5 points is the max I'm willing to give it. And again, the reason why is because if the level is going to work, it typically works within 2.5 points. Again, I know that because I have statistics to back it up. So essentially, here's a great trade here. This is today. Okay, the market closed just 45 minutes ago, that extended session there. And we came down right into, and here we go. I didn't have this one prepared at least. We came right down into our 200 moving average and we had divergence. Now, I don't know if there was a fib set up there because I did not prepare this, but essentially we had leg 2, leg 3, and then leg 4 up to the top. Again, I'm not an Elliott guy, but just from a visual perspective, you could make the argument. We got a nice push, pull back to what looks like the 38. In fact, I wouldn't be surprised if that was the 38 right there. Yep, right off the 38. We got a peek through of 1 point. Okay, and then we had a second leg up, a pullback that was a really, really drastic retracement. That went through all 3. However, if you notice, it did actually pull back right to the 38% retracement and bounce, and then come down and bounce off the 61.8 and bounce. But it came all the way into 75, which is something that I'm not going to talk about today. I'm just watching the 75 off of a suggestion of one of my mentors, because when you do get a more protracted pullback, a lot of times we do see a push right into this 70 area, 70 to 78. I think the fib level is something like 78 point whatever, right? But don't get too busy with that. I think the point here is that the levels don't always work, but a lot of times what we do see is we get a reaction. There's just not a strong enough move to get a bigger push, right? So in this case, we got the 38. This case, we got the 61, which was also our 200 moving average. There's a beautiful trade setup, okay? Right off the 200 and the 61.8. However, in this case, maybe it's harder to argue divergence, but all the way back here, you could argue we've made a higher low, and here on our indicator, we actually did make a lower low. So there was divergence arguments there as well. So here's a great example of coming down into a level. Everything lines up. You notice that there's divergence going on as we're testing into it. And had you have taken that trade, didn't work, right? And this is why you want to use that risk management. So let me bring this back here. So my argument is that if you're testing into one of the various levels I just mentioned, it shouldn't break by more than a few ticks and should turn if that's going to be the type of trade I want to take, okay? And you're going to see time and time again, it's holding all these levels. I've given you enough examples for you to hopefully convince you that yes, in many instances, when it comes into these areas, it does find resistance within 2 points, right? So now we have a defined risk for our trades. We know that if we're pushing into a level, that it shouldn't break by more than 2.5 points max, okay? There's another element to this risk management, and that is the actual divergence setup itself. So stick with me here. Hoping this is linear enough for you to understand. But essentially, if you have a level, but we get a divergence like in this example, and it peaks through that level, well, originally, like I said, usually the levels, if they're going to work, are going to hold within 2 points, right? So there's the level that should have held within 2 points, 60 down to 58. However, and let me see if I can zoom this in more. Hopefully you guys can see. If we were relying on the 200 moving average here, and maybe a fib was even lining up right there, that would have been our area, and 2 points would have been the max amount of risk I would have given the trade. However, the divergence formed down here. Okay, so the risk has actually been defined by the divergence in this case, not by the level. Okay, so if we actually hold the level and we have divergence, we're going to want to rely on the major low where the divergence formed, or if you're up top, the major high where the divergence was formed. In this instance, we got a double top, we got a divergence, and we actually happened to be at 50% of the day before, which is one of my previous daily power levels. So in this case, the divergence and the level happen to be right at the same spot. Perfect. But sometimes we do get something like this. We also, and again, I don't have like predetermined examples outside of the ones I mentioned earlier, but let's see if we can get something else that might meet the criteria for an example for you right now. Here's a good example. We're essentially testing into the 200 here. It wasn't to the tick, but it was within 1.5 points of the level. So in this instance, because the divergence formed up here, we want to use that as our predefined area where we're wrong on the trade. So if the market pushes through where the divergence formed here, we are technically wrong above that high. So that's where my 2 points of risk would then go, just right above it. Oop, wrong button. Okay. Not down here, not off the level itself. Only if the divergence does set up off the level would you want to do something like that. So you can see how you can use the divergence setup to then define where you're wrong on the trade. And you technically, if you get your divergence set up, then you're wrong if it breaks right below it. So you could even tighten your risk. Once you see your divergence set up, let's use this as an example. We come down into the 200 moving average. We get one of these beautiful fractal patterns, divergence patterns, and it turns. Well, now I know when I get in the trade that if that major low breaks, I'm wrong, because that divergence should hold off the level and then go in the direction you expect. So what's even better about using divergences is that if you can get in the trade and you're at the top end of the divergence, or I'm sorry, in this case, the bottom end of the divergence, and let's say you entered maybe 2 ticks above that low, like let's say you actually got long off of the 200 moving average here, our slow moving average, and it came down to 39.59 half. Well, guess what? If the market starts going in the direction you expect, you know that you're now wrong a tick or two below the low. And in this instance, you would have taken on just about 1 point of risk, 4 ticks on the S&P 500 futures. 4 ticks of risk on that type of trade. And again, I don't know how far you're going here. If you're scalping, which is what we're talking about here, you could have gotten long at 60, taken some profit right off the fast moving average, because you never know if it's going to come right up into the fast moving average and fail. So you would have gotten yourself a little 2.5 point scalp. And then maybe if you were holding on with multiple contracts, you could have actually taken it up to the next expected support and resistance level, which again, I have this on my chart from higher time frame analysis. Okay. So there's a great example. There's your defined risk. And that's essentially it, guys. I mean, that's what it all boils down to, defining an area in the chart that makes sense to hold, but based on levels that make sense, seeing your signal, getting the trade on, and making sure that your stop is no more than 2 points above whatever high you're relying on or low that you're relying on. And that's how I scalp the S&P 500. I have my 512 chart. I'm looking at where we're pulling back into. I'm looking at higher time frame levels and higher time frame fibs, and I'm looking at the short time frame stuff. So that's essentially it. We can open it for questions. I don't see any questions in the, give me 1 second. Yeah, I don't
Hey,
see
I'll
any.
moderate the questions for you. You actually can't see them as presenter.
Okay.
Only if you're the organizer can you see it. And we didn't get you promoted before you started. So, guys, if you have any questions, feel free to type those in. Again, you can find Justin at jtfutures.net. I put his website there in the chat for everyone. Should be able to see that. I've got a couple questions for Justin while I'm waiting for you guys to type your stuff in there. Hey, what
Okay,
were the moving averages you were using? Oops.
should I quickly mention my trading program?
Sure. Make any.
Let me just bring that up really quickly. I will be running a 3-month trader training program in 2023, starting in early January, where I'm going to go through all these concepts in major detail. Today, even though I kind of laid things out pretty basic, there's still lots of details and lots of things that I didn't have time to get into. So I'm going to be spending 3 months basically teaching you everything I know and how to trade my trading system. We're going to be trading on the live market as well. So if you join the course, we're going to be doing like a 2-hour kind of classroom course, and then a day or two after, we're going to actually go on the live market and focus on the concept that we taught that week, see how it's actually playing out for real on the live market, and maybe even get some decent trades. And if you join us for the program, there's going to be one-on-one coaching offered, and my goal is basically to help develop you as a trader and give you the tools and knowledge that you need to become a successful trader. Remember, what it comes down to is not necessarily the system or what tool you're using, but it does come down to you at the end of the day. Can you execute the system? Can you withstand drawdown, that mental fatigue, that, you know, of dealing with losses and then being able to proficiently execute after those series of losses? There's a lot of other parts to it, but I'm going to try to give you all the knowledge and the tools you would need to become that successful trader that you want to be. If you do end up signing up with us today, or you did sign up for the webinar, we'll give you another 10% off the already reduced price of the program. So originally, the price of the program was $5,000. Okay, we're offering it 50% off for $2,500. And if you send us the code Tiger10, send me an email with the code Tiger10, I'll give you another 10% off $2,500. So that means you'll be getting the whole thing for $2,250. Okay, you're also going to get that Hopal indicator that plots that holy orange power level I mentioned, plots the previous day open, high, low, close. That is available actually on my website. If you're interested in that indicator, you can buy it for lifetime. You just get the file. Or like I said, if you join us for the program, we would also give you that for lifetime for free. And like I said, we'll have a one-on-one coaching call at some point during the program as well. So that's my little pitch here. And I guess we could open it up to questions.
The moving averages you were using with the 512 tick chart, what were they again?
So I have a 34 EMA. That's my fast moving average. And I can't vouch for that working on a 1 minute or a 10 minute, but I know on the 512, when you're in one of those moves, it will revert down to that 34 EMA and bounce pretty fantastically. The other one is the 200 EMA for my longer period moving average on that chart. And then finally the VWAP, which is anchored to the Globex Open.
And you were mostly trading E-mini futures, S&P. Are your indicators, do you use your indicators on the other E-mini contracts?
I'm not sure if I understand the question. I trade specifically the S&P futures, the ES.
Right. I mean,
You know,
have you
both
used them on the
micros.
NASDAQ and the Dow minis and the?
Yeah, I don't really look at any of that.
Okay.
You know, once I got into S&P, I just stuck with it, and it became kind of my specialty, I guess.
And you're trading the mini contract as opposed to the micro contract?
I do both. So I've got a proprietary account that I do trade minis in, and my personal account, I usually just trade micros. There's really, it would have to be some type of major alignment for me to want to put more larger risk on my personal account. So primarily the micros on my personal account.
Do you have a email address on your website here, or how do you want people to contact you?
Yeah,
Just
so it's
contact
JT
info?
Futures. I'll put it in the chat. It's jtfutures1@gmail.com. jtfutures1@gmail.com. So that should be in there.
Oh, so when you put something out for everybody, make sure you select everyone, entire audience. I'll do it.
Okay, yeah, because it doesn't have that.
It should be in the pull down menu. Yeah,
It says send to organizer only.
yeah, I did. I sent it. I resent it to everybody.
Okay.
Hey, so I've got a couple general questions for you that I'd like
Yep.
to ask of various guests. Hey, based on what you know now, what advice would you give yourself when you started trading?
Well, what I'd say first is that in my experience and what I've seen with other people, and especially students, is it doesn't matter what advice you give somebody. It seems like you kind of have to go through the weeds and go through the mistakes yourself. So you could tell someone, oh, don't widen your stop, right? You know, that's really, really important to mitigate your risk. Make sure you're not giving away whatever money you made or whatever money you have. So, you know, things like that. The trader is more than likely going to, you know, not honor that rule, going to get a big stop out, and probably going to do it multiple times before he learns the lesson, right? So what I would say, with that being said, I would say probably once you find a system that resonates with you, that, you know, that works for your personality, that works for your type of goals, I would say do not worry about money. And again, this is something that someone told me when I started, but then, you know, all I could think about was, oh, I just have to make this much a day. I can make this much a day, 5 days a week. I was so focused on the money, but that is going to set you back. So I would say don't focus on the money. Once you find that system, start small, start with micros. In fact, you should probably start on a demo sim account, at least just to prove that you have that, first of all, that the system has some positive expectancy to it, and second of all, that you can actually execute that on a demo, and you can see that the account is growing over time. Obviously, you have to remember there's drawdown, but that's important. And once you finally do prove that you can do it on a sim, move to micros and don't focus on how much money you need to make or what you need to make at the end of the day, the end of the week, the end of the month. Focus on the trading process of waiting for the trade setup, putting the trade on where it should go, making sure you're not risking more than you should be risking, things like that. Focus on that process, and assuming that you have a system that works and assuming that you can execute the system, the money will follow. So that's what I would say as far as advice to myself as a newbie. Of course, I probably I didn't follow it.
So can you tell us any other mistakes you made as you learned how to trade, or mistakes you think new traders typically make?
Starting out too big, right? Which kind of goes back to what I said originally. Trading too big is one big thing. Expecting that there's like a finish line, like that, oh, you know, I trade every day and in 2 years I'm consistently profitable. Like expecting that there's some place that you get to as a trader. I think that's something that maybe will set people back, because they're always kind of waiting and expecting for something to kind of set up for them. And then just expecting to make money from the start and not realizing that this is a serious business. It's very hard, you know, over 90% of people just can't do it, they fail. And not realizing that you're gonna have to put in a lot of time before you start to get into the groove. You figure out, you know, how all of it works, how you work as a person, and everything like that. So having realistic expectations for how long it's going to take before you do start to realize some of the profits.
All right, speaking of realistic expectations, how long do you think it takes for the typical new trader to become a profitable trader? I don't mean trading full time, I mean to be profitable.
How long would it take? Well, it's a hard thing to answer, right? I mean, people are at all different levels. They have their own innate abilities that they might have that someone else doesn't. They might have a mind for trading where someone else just does not have that skill set. So yeah, I think it's a hard question to answer. I think I've never met a trader who's only been trading for 6 months or a year and they're just consistently making money. Usually what I see, and for myself, it was probably about 5 years before I even started to break even and start to see a little bit of profit. So usually what I find is people are trading at least 3, 4, 5 years before they start to see some type of consistency. That doesn't mean that in your first year you don't get some incredible trades in and you start to get some consistent profit. The problem is, can that withstand the changing markets? Can it withstand changing things that are going on in your life, circumstances in your own life, things like that? So I think I would say 5 years would be a realistic time frame to get the life experience, getting the blown up accounts and the drawdown and getting some success and getting excited and then seeing it all come back to break even. You know, it takes a long time to kind of figure it out and see, you know, how to control yourself so that you're not giving all your profits away. It's not an easy game. So, you know, like they say, it takes 4 years to get a university degree just so you can get an entry-level job somewhere, and then probably another 5 to 10 years to work your way up at that company. So, you know, same thing with trading. Expect it's going to be a long haul. It's not going to be a quick get rich quick scheme. So.
All right, that's a more than fair answer. Do you have any books on trading that have helped you along the way?
To be honest with you, not really. I mean, there's like the classic, the perennial, you know, Trading in the Zone with Mark Douglas. That book, actually, I think the 2 books, was it the Disciplined Trader and Trading in the Zone? They're 2 great, I think probably the only books that you really need to just get, again, they lay out Mark lays out the realistic, you know, the reality of the game. And the struggles and the ups and the downs and the realistic kind of reality of the fact that even though a trade works 5-6 times in a row, it doesn't mean the next time you put that trade on, it's going to work. So those are the only two books I would say. There are other books I've read. You know, I don't think they actually did anything that leveled me up in my trading or anything, though. There was maybe some good information here and there, but the psychology was really the most important thing for me. I had the setups, you know, I developed the system, but the psychology was really the hardest part. So if those two books, in my opinion, would be a good place to start. I think what's more important though is once you have some type of system, or you're trying to develop a system through just back testing and looking at the market and trying to create something yourself, it's more important that you're just watching the charts day in, day out and developing your edge. More important than, you know, how many trading books you read. So that's my opinion on books.
And then how did you decide to trade futures? You talked about, you know, having a strategy that speaks to you, or as people are looking for something that's going to work for them. So how did you decide that futures works for you?
Well,
were you trying to? I mean, I'm specifically asking, did you try to trade other things along the way as well, and that this is day trading futures, E-minis was your thing? How did you come to that decision?
well, my trading journey started with crypto, as probably everyone my age in their 30s and 20s. It started with crypto, and as you would imagine, it's all unregulated markets. So, you know, I was literally on Poloniex and Bittrex, and I don't even think Coinbase was really a thing for me at that point. And I learned a lot in those 2 years. But I didn't like the fact that I also wasn't necessarily making lots of money. So I didn't like the fact that it was on these unregulated, you know, brokers and all that kind of stuff. So I decided to take a look at just, all right, what are the real markets here? And, you know, Forex comes up, futures comes up, trading just stocks comes up. And one of the main hurdles for me was having a lot of, you know, initial capital to start with. So to trade stocks, you know, you need your $25,000 account or more. You need this and that. And I just thought that was just too much of a barrier to entry. So futures made sense because it was realistic that I could open an account with $5,000 or maybe even $2,000, and I could get my feet wet and actually start trading. So that's what really kind of interested in me, was like the fact that I didn't need a lot of money to start, and the fact that the S&P is just, you know, everyone knows the S&P. It doesn't matter where you are in the world. Whatever news is coming out is probably relevant to the S&P. So I thought that that was maybe another kind of important thing to keep in mind, is that, you know, global events that I'd be able to see in the news every day was potentially going to have an impact on that market. So I would have a little bit more of a clue as to maybe when there would be higher volatility or things like that.
All right, looks like we're done here. I asked all our questions. We want to thank Justin for joining us today. Lots of good stuff. Lots of stuff you guys can apply and think about. Lots of ideas that we've probably heard about before. Divergence, Confluence of indicators, fractals, tick charts. So lots of good stuff. And if you want to contact Justin, again, you go to his website, jtfutures.net. His contact is right there, as well as in the chat. So we want to thank Justin for joining us, and hopefully you will join us for another webinar this week. Again, we'll have more guests as well. So thanks for joining us. We'll see you guys at another event.
Thank you.